Good afternoon, everyone, and a warm welcome to today's City of London full-year results webinar. I'm Janina Sibelius, Senior Manager for Investment Communications here at the Janus Henderson Investment Trust team, and I'll be moderating today's session. Thank you for joining us as we look back on the Trust's performance over the past year and hear directly from the team. For today's Q&A session, you can submit questions via the speech bubble picture called Q&A at the bottom of your screen. I will now hand over to the fund manager, Job Curtis, who will shed more light on the past year's performance.
Thank you very much, Janina, and welcome to everybody who's listening. So I'm going to talk about the 12-month period that we reviewed to the end of June, and also talk about how the Trust is positioned for the current market conditions. So to start off, just with some background on the Trust, that picture you're seeing is actually the brewery, which the Trust originally was a brewery company. And in the 1930s, the brewery, which was in the City of London on the banks of the Thames there, closed down and they turned into investment trust. But for many years, of course, our objective has been long-term growth in income and capital. And we've also been very proud of our dividend record. We have an independent board of directors, which is a great advantage for an investment trust. And our chairman is Laurie Magnus. He's been chairman since October 2020. And he had a long career in corporate finance, which is advising companies. I just want to draw your attention to parts of his chairman's statement, which was issued on 17th September on two topical issues. The first one is that we made clear that we will continue with our policy of issuing shares and buying back in quite a narrow range within a rarely exceeded 3% over the last 15 years. And this means that our investors have less volatility in terms of the relationship between our share price and asset value than the majority of investment trusts who don't have such a policy. And secondly, we made very clear that we will continue to pay our dividends out of income and wouldn't contemplate paying out of capital unless in very exceptional circumstances, because there's quite a fashion at the moment for investment trusts to pay dividends out of capital profits. And we think whilst that can work in a rising market and people don't really notice, we think in a falling market, which you do get from time to time, people will be quite upset to have their dividends paid out of declining capital. So turning to the next slide, I've been manager now for 34 years. It's been a huge privilege to have done this for my career, really. I work closely with David Smith. We've worked together for over 10 years, and he was appointed deputy fund manager just over 4 years ago. Our investment management fee is very competitive, one of the lowest in the industry at 0.3%. And our ongoing charge, which is all the other charges added, is the lowest in our sector at 0.36 and was actually down from 0.37 the previous year. During the period of ultra-low interest rates, we secured some very cheap long-term debt, as you can see. So this is going out for 25 years, two tranches of debt with an average coupon of about 2.8%, which is way lower than the government can now borrow at. David and I work in the Janus Henderson Global Equity Income team. We've got 14 of us, and different perspectives, different levels of experience, and we work well together, and a fair amount of obviously challenge within our team and debate as well. We all work for Janus Henderson. This was formed as a merger between Henderson's, which was UK based, and Janus, which is US based, and it's worked very well. Certainly Janus has brought us that knowledge of the US market, and which is really helpful in terms of understanding how large companies compete globally, and also we're known for an exceptionally strong team of analysts. We've got about 36 sector analysts, and very, very good, well known within industries, amongst the best. So in terms of Citi's investment philosophy, it's valuation driven. I take great lot of care and attention to the stock valuations where it's reflecting future prospects. I start with dividend yields, but we have to be in companies that are growing their profits because they can grow their dividends and investing enough for the future. So it's not dividend yield alone is not enough by any means. And we look at a whole range of valuation measures. The other aspect is a very conservative approach. Both David Smith and I are both conservative characters, and we like companies that good cash generation, they're best able to support dividends and capital expenditure. And we like strong balance sheets, especially for cyclical companies. We don't like a mixture of what they call operational financial gearing. This chart at the bottom just shows you, looks back at UK market the last 25 years and shows you where the best returns have been. And they've actually been in the kind of middle of the dividend yield range, in the 2 to 4% and 4 to 6%. And that's really where the majority of our portfolio lies. We've got some lower yielders in for the growth and some high yielders in primarily for their dividend, but that sort of sweet spot is the middle area of the market. So let's look at the performance. The chart shows you the performance since I became manager, and you can see we're well ahead of the main UK index, FTSE All Share. We're also ahead, I'm pleased to say, over 1 year we returned 16.8%. So we're well ahead of the FTSE All Share, which was 11.2, and both our equivalent investment trust and OEIC sectors. And we're also ahead over 3, 5, and 10 years, I'm pleased to say. So how has that performance been achieved? Before I do that, just a slide which we need to show you, just showing the performance for each kind of 12-month period over the last 5 years. So looking at where the performance has actually been achieved, the best sector, look, this is just looking at the sectors. The best sectors, what's called investment banking brokerage services, which is a technical name for what should really be financial services. And this sector includes M&G, which is a mixture of life assurer and fund manager, which performed particularly strongly for us. It had a very high dividend, but it also it re-rated as people as people appreciated the dividend. And in addition, it's very strong in the private credit side of fund management, which is an area it's going strongly. And a big Japanese insurer company, Dai-ichi Life, is going to take a stake in it, which has helped support the share price. Tobacco, which is obviously, it's not an easy sector, but the shares are very lowly rated, and our 2 tobacco shares did perform very well over the year. They're very cash generative and very good dividend payers. And then life assurance companies quite similar to M&G, but pure life assurers, in particular Phoenix Legal and General, also contributed. In terms of pharmaceuticals, we were underweight, which means having less than the index, and that helped relative performance, as did being underweight in the mining stocks. The biggest detracting sector was aerospace and defence, where although we hold BAE, we don't hold Rolls-Royce, which hasn't really paid a dividend, but it has performed very well. It's just started paying a small dividend. We also suffered in electrical equipment, food producers, travel and leisure, and real estate investment trusts. Next slide, please. Turning to the biggest single stock contributors, AstraZeneca, though we hold it, we are underweight relative to the index, and so it didn't have a great year. So we benefited from that in a relative sense. Within the bank sector, I'll talk a bit more about banks in a minute, but NatWest performed extremely well over the year, and both in terms of share price performance and dividends, and so that was the second biggest contributor. Peel Brands is a tobacco stock. BAE Systems is our main defence contractor, the biggest by far in the UK, but also the 5th biggest defence contractor in the US, and also with growing interest across Europe, very big in Europe and in Asia Pacific countries like Japan and Australia. They have important sales too. And then I've already mentioned M&G, and I've already mentioned Rolls-Royce as our biggest detractor. Merck's a US pharmaceuticals stock we hold, which has done well longer term, but detracted over the 12-month period. And then within the UK, within the banking sector, we don't hold Standard & Chartered, and although we hold HSBC, we're underweight, so they detract from performance. And then oils, our French oil stock, which has again done well long term, detracted over the 12 months at Total Energies. In terms of portfolio activity, I'll sort of summarize this, but we had 3 takeovers in the year, which is another illustration of the cheapness of the UK market. But Direct Line, the insurer, DS Smith, a packaging company, and Britvic, which is a soft Pepsi Cola bottler, all got taken over. The Direct Line, we switched into Admiral, which is another motor insurer with probably a better track record. We also bought some TP ICAP, which is an intermediary in financial markets. And in the oil sector, we bought a new holding in Harbour Energy and sold out of Eni, which is an Italian-based international oil company. 2 small positions, which we didn't do very well in, DFS Furniture and Burberry, where they both stopped paying dividends, and we sold them. And we also sold Pennon, the Southwest Water utility, but we do hold positions in Severn Trent and United Utilities in the water sector. Looking at the revenue picture, we're incredibly proud of our dividend record. That's 59 consecutive annual increases, the longest of any investment trust. We put the dividend up by 3.4%, marginally ahead of our earnings per share, up by 3.3%, and our revenue reserves per share increased by 5.3%, which we dip into during difficult years. I mean, you can see from the table, the year 5 years ago to the end of June 21, we had to use reserves. This was kind of in the aftermath of the COVID pandemic, when companies were still cutting dividends and not rebasing them, not bringing them back quickly. But the next 4 years, including last year, we've covered our dividends. So last year we paid out 21.3p, we earned 21.57, so it was a payout ratio of 98.7% with the rest put back into reserves. So this chart shows you the dividend record going back 59 years, and I think key is a core of consistent companies within the portfolio that can grow their dividends through the cycles. Having said that, I think it is a diversified approach is very important. You don't want to have all your eggs in one basket, and the chart on the right just shows you the spread of sectors so we're not kind of overly exposed to any one particular sector, although we have got quite a strong weighting in the financial group. If you added banks, financial services and insurance together, it come to about 33%. So that's an important part of our sectors. But the next biggest area being consumer staples, which are kind of everyday products that companies sell, which tend to be more stable. So now I'll talk about a bit about the market, how we're seeing it at this moment, and how the portfolio is positioned. And obviously, this year has brought tariffs, which like from the US, which we haven't seen since the 1930s. These are much higher tariffs, and it's been quite a lot of volatility surrounding them. The equity markets have recovered very strongly from the initial tariff announcements in April, as you're probably aware. And obviously, the US has reached agreements with various countries, including the UK, but the tariffs are much higher than they were previous to the Trump administration. And in my opinion, it's probably a bit early to sort of really know the full impact of tariffs. I mean, obviously, it doesn't affect services, which are a large part of the UK economy, and we have a relatively small manufacturing traded goods sector, but it's so in some respects we're relatively less affected. But it is, we are a bit in the unknown, with these policy changes. I mean, UK interest rates have been on a downward path. They've come from 5.25 down, base rate down to 4%. I think there's a halt at the moment with inflation back at 3.8%. It's probably going to get to about 4% before it starts to go down again. And obviously wage growth has been quite sticky. So I think the Bank of England is treading cautiously, but I would expect interest rates to go down again, on a 6 to 9 month view. We think the valuation of UK equities remains very attractive. The dividend yield is 3.6%, but in addition, there's a large amount of companies taking advantage of the cheap valuation to buy back their own shares. And if you add up all these buybacks they're worth about 2% of the market cap of the whole of the UK market. So you're getting a total distribution yield, which is the dividend yield plus the share buyback yield of over 5.5%, approaching 6%, which is a pretty attractive starting point. The two charts shows you the price earnings ratio, which is relation share prices to profits per share or earnings per share, and that's in line with the long-term average. I mean, the bottom chart shows you the dividend yield compared with fixed interest, whether base rate, 10 or 30-year gilts, and the dividend yield is below fixed interest, unlike during a period of ultra low interest rates prevailing from 2015 to about 2022. But this is a more natural relationship, in my opinion. Most of my career, equities have yielded less for the very good reason that you get dividend growth from equities, whilst by definition, fixed interest is fixed. In terms of the structure of the portfolio, we have about 79 holdings. We're predominant in the large cap end of the market, 81% in the FTSE 100 and 11% in the rest of the UK market. We've reduced our overseas listed shares. Back in 22, we had about 17% overseas listed. We're now down to about 8% because of the better value we see in the UK market. And our gearing at the moment, it's about 5.3%, making use of those very cheap loans, which I talked about earlier. In terms of sectors, our biggest single sector is banks, and where we moved overweight 18 months ago against the index for the first time since before the financial crisis. And in particular, banks are benefiting from a big tailwind of the hedges they take out, which are typically on a 5 to 7 year basis. As they roll over from the very low interest rates, they can reset them on the much better interest rates that are prevailing today. So we think the banks have got enough capital now, and we've seen some very pleasing share price and dividend performance. Financial services is our second biggest sector. I talked about M&G earlier. We've also got companies like IG Group or St James's Place or Rathbones in this part of our portfolio. Then personal care, drug and grocery stores. This is one of the leading consumer staples sector. Unilever is our biggest holding in the global consumer products group. We also got a big holding in Tesco's in this part of the portfolio in Reckitt's. Oil was slightly underweight, but we have got 7.6% of the portfolio in oil, with our biggest holding being Shell. And then tobacco, which has been performing very well. We've got BAT as our biggest holding. We also hold Imperial Brands. This chart here is very important, the one on the left, the pie chart, because what we can do is look at the underlying sales or revenues of the companies that we invest in. And actually, if you drill down, 60% comes from overseas. So actually, you are getting a lot of exposure to kind of global growth through the UK stock market and through our portfolio. And 40% is accounted for by UK sales. And as you can see globally, it's a pretty good spread with plenty in North America, plenty in Europe, ex-UK, Asia Pacific, and emerging markets. The chart on the right just shows you where our big weights are. And so our biggest overweight is financials. It's also the biggest part of our portfolio, around 33%. And, some 5 percentage points overweight, followed by consumer staples, which is, again, that's the second biggest part of our portfolio, 18%. Our biggest underweight is consumer discretionary. These are companies that are sensitive to consumer spending, where we've got like retailers or travel and leisure. We've got a fairly low weighting here, only about 2 percentage points of the portfolio, slightly over 2% is in consumer discretionary. We're 5 underweight against the index, and healthcare is our second biggest underweight. We've got some decent positions, but but we struggle a bit with some of the valuations. So we're 4 percentage points underweight in healthcare. Looking at the top 10 holdings, you can see 3 banks in the top 10, HSBC, NatWest and Lloyds, and then 4 consumer staple stocks, BAT, Unilever, Imperial Brands and Tesco's. We've got 2 stocks I call real growth stocks, which are lower yielding, which are BAE Systems, seeing a terrific growth in demand for defence, and RELX, which is a business information provider and for businesses and professionals, and providing analytics and information, which has got an exceptionally good track record. Looking at the next 10 down, you've got M&G and financial services. You've also got in the life insurance sector, you've got Aviva, Phoenix, and Legal & General. Our biggest pharma stock is pharmaceutical is AstraZeneca. Another bank, Barclays. Our biggest utility is National Grid. Our biggest REIT or real estate investment trust is Land Securities, and Rio Tinto is our biggest miner, with BP being our second biggest oil stock, with Shell, which was in the top 10, as you might have seen, is our biggest oil stock. So to finish off, before I hand over to Janina for questions that might have come through, it's 59 years of annual dividend increases, the longest record of any investment trust. We're immensely proud of it. It's been achieved through having a core consistent companies in the portfolio, but also in difficult years for dividends, making use of the investment trust structure and paying out of our revenue reserve. We have very competitive charges. We've got the lowest charge in our sector at 0.36%, actually down on the previous year when it was 0.37%. And we've achieved long-term outperformance of the UK market, the FTSE All-Share Index being our benchmark, through a conservative investment style. So thank you very much for listening, and I'll now pass back to Janina.
Thank you, Joe, for the presentation. So we'll move on now to the Q&A portion of the webinar. And again, if you haven't already, you can submit questions through the Q&A chat, which is the icon at the bottom of your screen. I think I'm going to start off with a little bit more of a wider question on the economy itself. So you touched on the tariffs in your presentation, Job, and as you said, we don't yet know the full impact of the tariffs. But how have you adjusted your investment strategy to mitigate any potential risks and capitalize on the opportunities?
Well, I think, as I said, it sort of affects more manufacturers of goods rather than services companies. A large part of our portfolio is in services type companies. And when it comes to manufacturing, I mean, most of our companies do manufacture locally. I mean, for example, BAE Systems, the big defense contractors, got major factories in the US. So overall, we're not particularly affected on us, but it's something we're watching very closely. But it hasn't had a meaningful impact on us. You know, and there is small impact on some companies, but it's not been a massive impact on the portfolio.
Okay. And going to themes and sectors, what were the themes and sectors that stood out as contributors to performance over the past year?
Well, I think obviously, I think the financials are something to mention. I think the banks have performed very well, but it was initially the banks that performed well, but followed by financial services generally, like life assurance and the financial services stocks I talked about. And I think the higher interest rate environment is very helpful for financials. I talked about this effect on the banks, and also it's also quite helpful for insurers and life insurers in a different way. So, and I think also that you know, after the financial crisis, I think obviously, you know, banks had to increase their capital for many years, get them back to proper levels of capital adequacy. And for quite a few years, they weren't even paying dividends. And in addition, I think regulators, you know, really having not regulated them so tightly enough ahead of the financial crisis, were really kind of tightened regulation up. And I think, but I think now the pendulum's really switched a bit because you know, the politicians both in the UK and elsewhere, other countries, you know, are worried about economic growth. There isn't enough. We need more growth. You know, we can't afford for things without more growth. And I think they're beginning to realize that the banks are part of the solution. I mean, you don't get growth in the economy without the banks lending. So I think some of the regulatory constraints are being kind of relaxed a bit for the banks, which is helpful for growth for both the banks and the economy generally and their profitability. So I think it's a better environment, you know, for the banking sector, and I think that's quite an important theme. It's our biggest sector in the portfolio, and that's certainly an important theme in over the last year.
Okay. And sticking with themes, with the ongoing global shift towards artificial intelligence and data centers, are you considering increasing the trust exposure to these sectors?
Well, it is a massive theme going on, and it's obviously a huge amount of capital expenditure going into artificial intelligence from the leading US technology companies. I mean, I do slightly worry that where the returns will come from. I mean, the amount of capital expenditure going is absolutely staggering. You know, it really is huge, and there's a vision, you know, of what it can do, but it's quite hard at the moment to sort of see where the returns will come. But if you're in the food chain of this capital expenditure, obviously it is very beneficial for companies, some of the companies involved, and you've seen some huge moves. They're mainly large American companies, and you've seen some huge moves on the American stock market. But, you know, I certainly remember back in 99, 98, people saw the potential of the internet, and there was a huge kind of bubble in share prices then. But actually, it took for quite a few years for the actual benefits of the internet to come through. Everyone could see that what would happen eventually, but the real winners and losers, it took a while for them to emerge. So, you know, I do worry that some of the speculation and it could be a bit premature, but within our portfolio, I'd highlight one particular stock, which is RELX, which is in our top 5 holdings, which, as I mentioned earlier, provides business information analytics, and they are already using artificial intelligence and giving their customers a better service than they previously had. For example, and they're the second biggest firm providing legal information globally, including in the United States, and that they're really seeing real applications to help lawyers. But it has to be, you know, done with real accuracy. You know, you can't provide it like 95% accurate. And I think that's why I think a company like RELX, which has got a huge database and information going back decades, is very well placed to, and spends a lot of money on technology to provide the kind of the AI with the level of accuracy that the professionals like lawyers require. So I personally see it not. I mean, people have. It's been an incredibly good performer over long term. People, the uncertainty being what it is, people, debate whether how much they'll benefit. But I would certainly see that as within our portfolio a clear beneficiary.
Okay. Let's talk a little bit about the UK market. So how do you see the UK market evolving in the current economic climate, and what could help turn sentiment more positive?
Well, I think, the companies are, I mean, the thing about the UK stock market is that UK institutions like insurance companies and pension funds, for many years have favoured fixed interest because they're looking to really just cover their liabilities. And they were previously big owners of the equity market, and they've kind of moved very much into sort of what's considered less risky assets, though that can be debated. And then I think a lot of investors in the UK has also gone very global. The people just buy global funds. So I think, there used to be something called home bias. People kind of favor the home market. At the moment, I think UK investors probably got more in Nvidia than they got in the whole of the UK stock market. Nvidia's and Microsoft got market cap worth more than the whole of the FTSE 100. Each of them have. So I think the UK market is quite unloved in terms of not being biased. And I think the result is the companies have turned up as the marginal buyer. The companies have realized how cheap their stock is. And so you're seeing this huge share buyback, which I think, which I talked about earlier, but is very beneficial for those of us who remain as investors. And it's very enhancing as it's done at a cheap level. And we've seen it work very well in companies like Shell or Imperial Brands, amongst our top 10 positions. And some 60% of FTSE 100 companies have bought back their own shares. So I think this is a very helpful underpinning for the UK market. Obviously, economic growth remains quite sluggish, and there's a lot of uncertainty ahead of the budget. But hopefully, once the budget's out of the way, people at least stop talking about it, and we can kind of move on at that point. But I think, and as I said, I think as for the more domestic, I mean, UK market is very global in terms of the underlying revenues of the companies, but for the kind of more domestic end of the market, I think, inflation, I would be expecting to peak around 4% and then start to come down into middle of 2026, and that will allow the Bank of England to cut interest rates, which I think would be helpful for the domestic end of the UK market. But I think the valuation, we had 3 takeovers last year from companies in our portfolio, and foreign companies and private equity firms are continuing to make takeover bids, and that's another factor in the support. So the UK market this year, since the beginning of January, has actually outperformed the US market considerably, particularly if you take the weakness of dollar into account. And so that's really quite encouraging.
Okay, thank you. I think we're running out of time, but any questions that remained unanswered, we can have a look if we can get back to you via email. So as a reminder, the AGM is being held at 1 p.m. on Thursday, on 30th of October, here at Janus Henderson Investors London offices at 201 Bishopsgate. And there will also be a Zoom connection for anyone who can't travel. More details on this and how to vote your shares and attend, you can visit the company's website and have a look there. Big thank you to Job for walking us through the results today and giving his thoughts on the outlook. And of course, to all of you for joining us today. We will now end this session. Thank you.